Good morning. All right. It is 9 a.m. Eastern. It's time to have a cup of coffee. It's time to take a look at the stock market and see what's going on. We have had a pretty active week and we've had mostly down sessions. We had a pretty good down session yesterday. I think there was a lot of nervousness in the stock market. And as a result, we are faced with pretty much a 1.7% drop on the NASDAQ, which is going to be a little hard to overcome for the week. My portfolio is sitting slightly in the green for the month, and we've got 2 days left in the month, today and tomorrow. So if the stock market can be even or even go up a little bit, I'll be all right with that. And it looks like the Dow stocks, there's 30 of them, big companies that include Microsoft, Chevron, 3M, companies like that. It is picking itself off the mat. We had economic reports this morning already, and those economic reports I'm going to go over in a minute. But the Dow, it's trying to get into the green. It's up 0.63% in pre-market trading. So that looks good. The S&P is up 0.3. I'll take that. NASDAQ is up 0.31. I'll take that. I'm going to look at some stocks that live in the NASDAQ. I'm going to look at NVDA again. I'm going to look at CrowdStrike. I'm going to look at CRM, and I'm going to look at HPQ. Viewer requests are welcome. Is there a stock that you want to look at? Is there a stock that you want to take a look at the financials, crack them open, and see what's inside? Unassembled the Lego pieces of these companies to see if they're a good company to invest in and make a lot of money over the long haul. I'm a long-term investor. I'm okay with making profits in the near term, but really my whole philosophy is buying great companies, watching them rise, making a lot of money over time. I also buy small companies that have a bright future, potentially a very bright future, and really get windfall gains and appreciation over time. I'm not a trader. I'm not a day trader. That's just not the lane that I pick. I pick long-term trading, investing, and that's really worked for me. So it's worked for me year after year. It is nice to have a long-term vision because we have, let's say I wanted to take a week-long vacation, 2 weeks, maybe 3. My portfolio is going to be fine without me touching it. It's going to be just fine. I made decisions 5 years ago that I'm making money on today. I made decisions 4 years ago that I'm making money on today, and so forth and so on. So that's one of the reasons why I like long-term investing is I could take a week off when I want. I could take some time off. And I know day trading could be a little laborious, but I'm not going to take anything away from day traders. They've got their lane. I've got mine. We can coexist and both make lots of money. All right. So the stock market's trying to go in the green. We've seen what the NASDAQ has done for the week. So there was some news from economic perspective. It's just, I like to see the big picture of what's going on with the economy, what's going on with the stock market, which would affect stock prices. So GDP, gross domestic product, it is a broad measure. It's an economic term. If you went to college and were in a business program or economics major, you understand what gross domestic product is. It's a full measure of the country's output. And it grew 3%, which was a little higher than what investors thought. And I would make this a little bigger because right now it's kind of a night chart. So I apologize for that. But back to GDP. So GDP came in at 3%. We were expecting 2.8%. 3% is a very good growth for the United States. China grows faster because they're building their economy, building their country, and so forth. But 3% is very good. So that's kind of good news for the economy. I don't see a recession, getting from 3% to a recession. In my opinion, it's going to take 2-3 quarters to get there. So 2024, I think, is in the clear from any threat of recession. We may see something in 2025, but we're in the clear now. The other important piece of information is jobless claims. Unemployment jobless claims came in at 231, which is slightly below what was expected. This is not very high. So that's good because jobless claims were on the rise, and those could more, create recession. And really, they are a barometer for the economy. If people don't have jobs or they fear that they're going to lose their job, people stop spending money for good reason. So jobless claims came in a little lower, and that's, I think the economic news was quite good. The Federal Reserve is expected to lower interest rates in September, and they're probably going to lower them by like 0.25 or 25 basis points, as you might hear. And that's just a signal that, hey, we're going to begin to lower interest rates over time, just to make sure that we don't see a really bad recession. Or if these job losses continue, the Federal Reserve has two mandates: keep inflation down, keep people employed. So they don't want unemployment to go up too fast. Looks like Boss Haas is in. Hello, sir. AL stock. Let's put that one on the list. Check it out. And we will do so. Thank you for joining. All viewers, you want to check out a stock? Let me know. Let me know in the comments. We'll check it out. See what's going on with that company. All right, so that's the economic information. The economic information drives interest rates. And this is a stock investing channel, but these variables are important. It's almost like, hey, I'm going to drive from LA to San Francisco. Got to check the weather. Man, if it's pouring rain, you might want to think about your route and so forth. And interest rates really affect stock prices. Interest rates affect the discount rate that we use to discount free cash flows, to discount earnings per share. The overall, frankly, if in the 80s as an example, if interest rates are incredibly high, bonds can outperform stocks. So everybody goes to bonds. That hasn't happened since the 80s. But interest rates rise, it does have an effect on stocks. It's just good to know. Now, this rise in interest rates causes bonds to be more attractive, to be a more attractive investment. I buy bonds. I like to cover my living expenses for 5 years and take them off the table. So I have a bond ladder. I'm not going to talk about my bond ladder much. There's a YouTube channel. There's a YouTube video on my channel. You can check out bond ladders if you like. And I'm probably going to look at buying a little bit in my bond portfolio today because it's a good day to buy. So interest rates are up. Oil prices are also up, but I'm not going to go further on that. Okay, so sectors. Yesterday was a red day. Technology did the worst, and discretionary did second worst. Financials, broke even. Healthcare was close to even, and utilities close to even. But utilities, I don't invest in them. I mean, 5-year change, you would make 21% appreciation. No, thank you. I'd rather stay in cash. Industrials did okay. So this is what happened yesterday. We'll see what happens today. We'll see how things play out as we approach the market. All right. So Boss Haas wants to talk a little AL, Air Lease. Okay, Air Lease. I think these guys are aircraft leasing company engages in the purchase and leasing of commercial jet aircraft to airlines worldwide. This is probably a really good business right now. Travel is at record levels, all-time records. Just they're filling planes and they can't get enough planes. Boeing has had manufacturing issues, but this could be a really nice play. Very good suggestion. I hadn't thought of this. Now, as we approach 2025, right? I tend to think again long term, and I want ideas that are going to work in 2025. I like making decisions today that are going to make me a lot of money next year, 2026, 2027, 2028, and so forth. And when you find a really good idea that does that for 5 years, bingo. It's like, great. So Air Lease, it's a $5 billion market cap company. Revenue is 2.7. It's early, folks. It's 6:10 a.m. Pacific here. I'm in California. These guys are profitable. Okay. Man, look at this PE ratio. Compared to NVIDIA, that looks really attractive. That looks really attractive compared to anybody. All right, that's good. So what's going on with their growth? I see green on the screen, people. Green on the screen. That looks good. Take a peek at the quarterly. Most recent quarter, slight decline in revenue. Okay, so that's interesting. All right. So I like the revenue growth. I like the industry. So one thing that I cover, this is my desirability quadrant, right? So we're looking at Air Lease Corporation, and this is important for me to communicate just so that you understand how my logic works as I look at a stock. And when I look at a stock, I look at, okay, is this company incredibly desirable? Do they have a really strong barrier to keep competitors out? They're almost a monopoly. They're like, hey, here's an example. They're like NVIDIA with GPUs. They're the best. Nobody even comes close. So they get to raise their prices. They get to raise their revenue. They get to make profits and so forth. That's an example of a very desirable company, and the market really responds and values those companies at very high market caps. Okay. You look at the top 10 market cap companies on the stock market, they would all be in the green. The worst companies are down here that have too much competition. We're talking retailers, discount retailers. We're talking, restaurants. We're talking, businesses that, very little very little profit, very little cash flow. They're just constantly needing capital. Competition everywhere. At every corner, there's a competitor that's coming to take your customer. And then there's industries that are, more in the gray, meaning, they've been around for a while, but good companies operate quite well in those industries. An example might be like a 3M. 3M is a very well operated company. They have good ideas, they have good patents, but most of their stuff is I think there's competitive products out in the marketplace, but it's a well-run company. So that's investable. If I get a good discount, I see a company with some momentum, very well operated, I'm good to go in the gray. But my desire is to find companies in the green. Air Lease, I like where they're at. I like financial services, and I like that they're focused on aircraft. Okay. That's a good idea. And I would put them kind of like here, like mostly in the gray, but hey, they got some differentiation. They make themselves different. They have focus and specialization in leasing aircraft. They probably have long-term agreements. The airlines are probably very comfortable doing business with them. So that's where I would put Air Lease. That's the way my mind thinks. Now, based on that, I'm going to treat Air Lease like a company in the gray that has a little bit in the green as I look at their fundamentals. All right, so they're experiencing good revenue growth. Balance sheet, make sure we don't have too much debt. They have $454 million of cash, and total debt is almost $20 billion. Okay, that's a little high. So $20 billion. What's their EBITDA? Now, I may give them a pass if everything else is okay, but EBITDA is not available. That's weird. Why is it not available there? So that's the income statement. So EBITDA should be down here. So EBITDA. This is EBIT, and then depreciation and amortization isn't there, but I'm going to safely guesstimate that this is probably five times debt to EBITDA, which is kind of a violation of my three times debt to EBITDA. Now, the reason I'm might be okay with it is they're a leasing company. They have to work with debt. Okay, so let's put that aside for a minute and look at their cash flow. All right, you're making some cash. Okay, operating cash flow looks good, but we want free cash flow. So what's going on? Okay, I think because they're a leasing company. They're putting a lot of capital into their aircraft. But the thing about it is they've been putting a lot of money into their aircraft for the last 5 full years. So this is one of the things that I don't like about utility companies is they have operating cash flow, and then they have all this CapEx. And to me, CapEx is like you have to rebuild the business. In the case of these guys, right, Air Lease, they're a $5 billion company, $5 billion market cap company. And each year they have to put more than half of that back into the business in the form of capital. So these guys don't even produce free cash flow. So that is a deal breaker for me. This would not be a business that I want to invest in. That's just too much CapEx. CapEx goes on your balance sheet. And if we look at their balance sheet, it's probably going to have some long-term assets. And so we have, so why isn't their asset? Okay, here it is. Other long-term assets, those are all their aircraft. So they're putting a lot of that CapEx back in here because if they recondition an aircraft, okay, great. It's a more valuable asset. But my big concern is it's not like you had to do it once and then it goes away. Okay, I'm cool with that. You only you had to recondition an airplane. That's fine. But it is really the theme for the last 5 years. It's not going away. So having said that, this is a pass for me. I would not look at this further. It's just it's not a company that's going to be worth a ton more over time. So hopefully you found my comments interesting. Hopefully they're helpful to you. Trader Prad, what's up, man? Happy. Isn't this NVIDIA day? This is like the day after. So yesterday was awesome. Today, we're going to see if NVIDIA rises from the ashes, like the phoenix in the great state of Arizona, rising from the desert and showing itself. What's up, Trader Brad? Hey, I got to start joining your live stream, sir. And I got to start learning some of your techniques just to know, just to learn. You might give me a little more of an advantage, and I'm always looking for that. So, well, I'm a day trader. Sweet. Man, I'd love to see what you're going to do with NVIDIA. When's your next live stream? I'll tune in. I want to hear that. I want to hear what you're doing, how you're doing it, why you do it. Sweet. Yeah. Let me know. Let me know when I can join your stream. I'd be very interested in that. So, all right. So we talked about Air Lease. Now let's talk about NVIDIA. The stock was down quite a bit more last night, 2.99%, 3%. Let's call it 3. Now they are catching a break because the markets are trading higher, which is good. I think if it was just bad news, like, hey, the economy's bad, all kinds of bad stuff, I think you would have seen the stock probably sell off a little worse. But let's take a look. So I've done quite a bit of analysis on NVIDIA in the last 24 hours. I actually updated my model, and I'm going to show that to you in a minute. So without a doubt, NVIDIA is a great company, and just their valuation is, great times 3. And that's the problem, is their valuation has detached itself from fundamentals, right? So my investing idea and opportunity is investors have gotten carried away with NVIDIA. They've really rung up the price to a high level, and I've shorted the stock. Right now, I'm still in the negative. I think I'm negative at this price. I'm probably negative by 5%, 4%. But the story is intact, and I've been shorting the stock for 3 months. I think the story is intact, which is investors are now worried. Okay, and I'm going to show you where I think the forecast of their revenue is going to be and what's going to happen to the rest of the fundamentals. The thing that's really fueling the NVIDIA craze is the established investing community, like these guys here, right, have referred trust, and you have all these, hedge fund managers and people that could barely spell AI talk about AI like they got a PhD in AI. Oh man, it's going to change this, it's going to do that. And frankly, I don't have a PhD in AI. I've worked in technology, but I'm not going to claim to be an expert. But it just is almost like everybody's beating the same drum on NVIDIA. Oh, it's going to change the world. It's going to do all these awesome things. And I'm here to say that it might. It's really interesting. AI is really interesting. It's just not going to change the world in 2024 or 2025. It's going to take a while. The internet took a long time. These big, massive changes to the way we do things, they take a long time. The winners and losers are not identified yet. And I'm not talking about NVIDIA. NVIDIA builds the infrastructure, okay? They're almost like the miners that came to California a long time ago, 1849. The companies that made a lot of money were the ones that sold picks and shovels. And that's an analogy that is used in the stock market. The miners, for the most part, they all lost their money. So all the AI companies that are trying to do AI services and products online, they're struggling. And I could cite many, many examples. So that's going to take a long time. And if you don't have success where AI meets, the user, the consumer, the enterprise, you don't have anything yet. But when it does begin to create value, I think it could create a lot of value. So we're like 5-10 years away from it being real. But the whole establishment of an investing community is really, built up NVIDIA. That same establishment, if a few of the big players start getting out of this position, which a few have already, it's a house of cards. It could really come down fast, is my expectation. Now, fundamentally, they're a very sound company, and I'm going to switch over to my spreadsheet because I've done some work on NVIDIA. And what I did is I wanted to show, and I'm going to make sure you guys could see it. So here's the sales forecast. And the numbers that NVIDIA has put out have been incredible. And I tip my hat to them. It's like incredible that NVIDIA has grown that fast because they're already a big company. I think that's legible. And when you're you're growing your business like in Q3, and this is kind of backwards. We're going oldest to newest, from right to left. In Q3 of 2024, which is their fiscal 24, it was 205%. So that was 3 quarters ago. And then it was 265%. And they just closed this quarter, which was their Q2 fiscal. And so you see the growth rate, and you're comparing to get to this number, you're comparing the second quarter of 25 to the second quarter of 24. And you're comparing 30,000 compared to 13,000. Now, their numbers that they're going to compare to keep getting bigger. And the law of big numbers makes it harder to show a really high growth rate. So they already guided. They told us we're probably going to come in at $32.5 billion of revenue in the next quarter. That's going to be announced in 3 months. Based on that guidance, they're going to have 79% growth. You notice how the growth rate is really coming down. Sequential growth is from this quarter to this quarter. That is slowing down fast. We went from 88, 34, 22, 18, 15. Now we're down to 8. My point being is the NVIDIA business is beginning to flatten out. And that's exactly what the market does not want. If you're sitting on a $3 trillion market cap company, this is what you're expecting. You're going to stay there for the next couple of years. You're not going to flatten out. And based on what they're reporting, they're going to start flattening out, and you're going to clearly see it in 2 quarterly announcements. Next quarter, and then the quarter after is going to be even more eye-opening, which is going to be their year-over-year growth is going to be 54%, still very impressive, but their sequential growth is really slowing down. If we wake up in 2025 and NVIDIA is on their annual compares is only growing 15%, is this stock really worth $3 trillion? No, it's not. So having said that, having created this sales forecast with their data that they reported, not stuff that I'm, pie in the sky, I updated my free cash flow forecast because there's another element to the semiconductor industry that doesn't get taken into account. I read, I'm on Reddit, and there is a lot of chatter around how NVIDIA is building the AI economy and so forth. And that's partially correct, but mostly incorrect. They provide infrastructure. They provide GPUs. ChatGPT created the code and the large language models that use that infrastructure and create the value, which is you go to ChatGPT and you ask it, hey, can you create a term paper on the Civil War? Boom, it cranks it out. Google Gemini, which is the competitor to ChatGPT, same. They use GPUs along with other infrastructure, but Google wrote the code. So the value that's delivered to that consumer is Gemini, ChatGPT, Meta AI. Infrastructure is cyclical. You have a couple of really good years. Everybody buys everything they need. You have a flattening and usually a decline in demand. Study semiconductor companies and you'll see that. So I've been investing in semiconductor companies for a while. So I expect that. So what I've done with my free cash flow forecast is I've given them a very generous growth rate on free cash flow, 25%. I'm actually taking their first half of cash flows, multiplying it times 2, and then I'm adding 25%. So in the next 12 months, I'm expecting they're going to do $71 billion of free cash flow, which is a boatload of cash. And then the year after that, it's going to be even better, $89 billion, 2 boatloads of cash. But after that, hey, the cyclical nature of this industry, I'm expecting that the economy, companies are going to pump the brakes in 2026, 2027. And NVIDIA is going to be like, oh, not as much revenue is coming in. Not as much revenue, and got competition. The other semiconductor companies did not stand idle and say, oh, we'll just let NVIDIA take all that money, all that business. So I'm actually seeing a decrease of 15% in years 3 and 4, and then long-term growth 4%, which I'm very comfortable with. So this is the cash forecast that I continue to theorize, analyze, and really be comfortable around. It's my cash forecast. It's my money that I'm investing. That's my cash forecast, but I can stand behind it and reference, their data, how I got there. So I'm going to discount it by 8%. They have a quality balance sheet, plenty of cash. So when I discount all these cash flows I expect from the company, all those cash flows are worth 1.4 trillion. They have 34.8 billion of cash on the balance sheet and then 8.4 of debt. So to me, the company is worth 1.4 trillion. I did kind of a calculation of, hey, based on the stock price where it was at, they're probably going to come down a little lower than 3 trillion but let's call it 3 trillion in market cap. So they're about 51% priced too high, priced at a premium. And free cash flows is really the standard that I rely on to make my investments, especially on a company that's been around for a while, like NVIDIA. You can make earnings per share look quite close to their valuation based on their earnings per share. I use a P of 36, growth rate of 10%. But this is the method that Charlie Munger, the late great Charlie Munger, he never used earnings per share because he thought it was BS. And I see his point, but I think I use it because especially small growing companies could really put up good earnings per share and you can see their growth. And I take that into account. So I take this into account. When I blend the two and I put more weight in the free cash flow method, it's the company's being overpriced by 36%. That's my theory, and I'm sticking to it. I have a short position, and I originally put I was at $9,000 of capital at risk in that short position. I took some off the table yesterday, and I've got $7,242 at risk. And if I wanted to close out the position, I would lose 1%. So that's where I'm at. And this short position has been around for 3 months now. And at times, most of the time I've been underwater. I've been losing money. At times I've been up. I've been up about 10%. But that really leads me to believe that, hey, you know what? I was onto something 3 months ago, that this thing's just overheated. It's too high. And because I'm seeing that there's a lot of fear in the stock. The stock's not moving from where it's at. I think there's more reasons for it to fall than for it to rise. The concerns are really turning into reality. And once you start seeing these numbers, right? When you're seeing these numbers, okay, holy smokes. We haven't seen this in another company in their space, right? And I'm not showing you the screen, so I apologize. Let me do that again. So when NVIDIA was experiencing this sequential growth, it's like, whoa, everybody pay attention, pay attention, pay attention. But when they start showing this sequential growth, you got lots of companies that are bigger, that are more established, that have non-cyclical businesses like Google Alphabet. They crush it, whether in a recession, non-recession. They crush it every year. Meta keeps growing every year. They have upwards of 4 billion users of their platform. Monthly active users, it's early, I forgot the exact number. But those are businesses that are freaking powerful, man. NVIDIA is not that type of business. They design right now the best accelerated computing GPUs. Absolutely. That's a cyclical business. It's not like Microsoft. It's not like Google Alphabet. It's not like Amazon. Amazon, we're going to buy stuff Amazon no matter what. They're going to keep growing. Their AWS business, it provides infrastructure for really important companies. That's going to continue. Our friends at NVIDIA, that's not the business they're in. So that's my updated analysis on NVIDIA. I'll record a video on my channel and kind of put, I think I was trying to cross my T's and dot my I's on my whole valuation. I think I've gotten it to a good place. And, I'll put it out there on my channel, but that's my position on NVIDIA. I'm going to hold my short position on NVIDIA. My intent was, if it ends up being a 30% loser for me, meaning the stock price rallies and I'm sitting on a 30% loss, I will close it just out of discipline that, I was wrong. I was wrong, man. Stock market, took me out behind the woodshed and gave me a pretty good whooping. And I'll just admit it and I'll cite it and I'll say, this is what I saw. And I underestimated this and I probably got that wrong. And the market charged me a good price for that lesson. If it goes up 30%, I'll probably close it out because I think most of the gain that I'm expecting would have been attained and I'm done. And I'll make a video for that too. So we'll see where it goes. All right. Mike, the dividend investor guy. Thank you for checking in, sir. I can see your message. And this is one of my longtime viewers, members of my community. I really appreciate you joining, Mike. Thank you so much. Thanks for being part of my live streams for a while. Appreciate it. Pyro, good morning, sir. How are you? So, stock ideas are welcome. If you guys want to see a stock, I think we saw AL, we've seen NVIDIA. I've got a list of like 5 more stocks that I'm going to keep rolling on. But if you guys bring up a stock, we'll take a look at it and see what's up. Oh, you said DG. Am I not? Oh, I'm sorry, Mike. It's early in California, and I haven't even finished my first cup of coffee. In my defense, I need coffee to get everything to full speed. So I apologize. I'm glad you reminded me. I apologize for not seeing your message. Let's get to DG. And then we're going to look at AMD. AMD, man, I have looked at AMD for the last 15 years. So I'm glad to do it again. All right, so DG. Dollar General. These guys are in retail. Now, I've been doing business with Mike for a while. He puts out very good comments. We go back and forth on ideas. So when I make these comments, I'm hoping and I'm pretty sure that he's going to take them the right way, because I'm just going to share how I see it, and he may see it differently. And frankly, sometimes he's right. So Dollar General is a retailer, and they're in kind of an area of the market where it's all about price. You have to lease out real estate. You have to hire employees. You have theft concerns. You've got just a lot of challenges. And the best I can do with Dollar General is put them in the gray and put them like a little bit toward the green. 99-cent stores just went bankrupt, and it's unfortunate. I thought they were bringing a lot of value to the market, but you just don't make a lot of money. If you're selling a product for a very low price, you just don't make a lot of money. So I don't like businesses like this. I just don't see myself investing in Dollar General, just because, will I wake up in 5 years and Dollar General is worth twice as much? And heck, now they're doing something that's so innovative. They really have moved themselves closer to the green. No, I actually would not be surprised if Dollar General starts moving, and maybe I can put it over here, into the red, like our friends at 99-cent stores. And, as we look at Amazon, right? Dollar General sells stuff that you can find on Amazon. And now Alibaba is, offered here in the United States. And then there's another website in the US. I haven't used it. They sell really cheap stuff. I think it's called Temu. So they have to compete with them. So that's where they're at in my mind on the level of desirability for Dollar General. And they are getting killed pre-market. I didn't see that, but let's take a look. So did they announce? Okay, they announced today. Shares crater, financially constrained. Okay, yeah. So there's a couple of things I'm going to point out. So revenue growth. Revenue is green. That's fine. Now, we saw, and I could probably show it against CrowdStrike. So you have revenue at 40 billion, and you have your cost of revenue at 28 billion. So your gross profit is 12 billion. That's not a lot. Okay. When you look at desirable businesses, and I'm going to use CrowdStrike just as an example, but I don't view them as a desirable business. I shorted CrowdStrike. I made money on them. But the point that I'm making is their revenue is 3.5 billion. Their gross profit, because their cost of revenue is less than $1 billion, their gross profit's 2.6 billion, going to 2.7 billion. So the margin there is just much larger. So desirable business or desirable model, undesirable model. Okay. That's the biggest hangup that I have with retail, especially discount retail. And so many things can go wrong. You got, theft. I know theft is really hitting the premium retailers like Macy's and others. You got like shoe retailers that are getting broken into, and their shoes are being stolen, because a pair of sneakers these days, that's like $200 box, right? Well, these thieves go in and get 200 boxes, and they got a pretty good take, and then they sell them on Amazon. It's brutal. We got to stop it. I'm all for law enforcement in that area. It's just one more challenge that these guys have. So these guys are not very profitable. They are growing. The balance sheet, they may be getting killed because their balance sheet might be weak. Total debt is 18 billion bucks. They have 1 billion of cash. EBITDA. So EBITDA is 3. 18 divided by 3 is 6. It takes them 6 years to operate their business to pay off their debt in a very low margin industry. I'm smelling risk. I'm smelling like, man, you couldn't give me this business. Operating it is so risky. It's like, holy smokes. Their market cap is half of their revenue. Okay. So not like, of course, these are dated, but analysts are saying, oh, it's a buy and it's discounted, but not in my book. Cash flow. Free cash flow is impressive. Very impressive. Very good. 1.7 billion in free cash flow. And it looks like this is pretty, let me look at the quarterly. Yeah, it's pretty recent. So cash flow is pretty good. 1.7 billion in the trailing 12 months is pretty good. Again, I start with, is this a desirable industry for me? Is this a desirable company? And the answer is no. But if it was a desirable business, I could see getting to this valuation. You can get to this valuation. And after today, it's going to be probably in the neighborhood of 15 billion, right? They have a dividend. Okay. That's one thing. They do have cash flow. They will pay that dividend. I just think that this is going to be a decaying company. Year after year, it's going to get harder and harder. And they may end up where 99-cent stores ended up. Kmart, you remember that franchise? When I was a little dude, 5 years old, 10 years old, we used to go to Kmart. They don't exist anymore. They were a discount retailer. Just discount retail is so tough. So for me, it's a pass. It looks like their cash flow is good. They can probably afford that dividend. Payout ratio is 34%. But remember that balance sheet, okay? That balance sheet, that's a giant, giant problem. We saw that interest rates, I showed earlier, the interest rates rose a little bit. These guys are probably sitting on debt that they're paying 5-6% on, maybe 7%, because they're probably paying 7%, maybe 8% on their debt. Let's take a look at their debt cost. That'll be interesting. Interest expense. In 1 year, they pay $327 million in interest expense. Their gross profit is close to 12 billion. They're paying a good percentage of it in interest. Okay. Of their operating income, they're paying 13-14% of it. Okay. So just, giving you, how I see it, Mike, it is something like, if you saw an opportunity where, the market misunderstands it. And I think that in the next 12 months, it might rise to 140. I'm just making this scenario up. Maybe you go in, you make some money, you get out. You have an exit strategy predefined when you bought it. Get in, get out, done. But we have thousands of stocks to pick from. Thousands. You want a dividend stock? I'll show you quality dividend stocks. You want a retail stock? I don't want a retail stock, but if you want a retail stock, there's other stocks to pick from. You don't have to pick one that's a troubled, a sick puppy. Pick one of the puppies that's like really happy and energetic and is going to live a long life. That's what I would encourage you to think about. Let me catch up here. Sorry about missing your comment, dividend investing guy. Okay. No, you weren't blind. So I have to operate with the new site myself, Mike. So it's my fault for not seeing your comment. Sorry about that. So they're getting killed in the pre-market, and for good reason. I mean, it's just a tough business. So you want to look at so Acer 8, KRUS. I'm going to look at that. So we looked at DG, but somebody asked for AMD. So I'm going to put KRUS in the back burner. It's going to be next. Let's look at our friends at AMD. So AMD so what's interesting about AMD is AMD was a second fiddle to Intel for 15 years. Okay. And Intel obviously is falling off the face of the earth. They're in so many problems, so we'll leave that off to the side. And now AMD's second fiddle to NVIDIA. And AMD does produce a GPU. AMD did focus on performance for a long time. And I think that AMD might have a path to compete for the GPU market. And one thing about technology that I forgot to mention when I was doing my little piece on NVIDIA is, so I've been in technology for a while. I'm, you know, I've worked in the software space. I've worked in technology for 25 years. And over time, and you can cite me on this, technology per compute, like if you look at performance, storage, all those infrastructure elements, the cost goes down, prices go down. And that's inherent in every industry. Over time, prices of goods go down. Some commodities will buck that trend and appreciate in value, like food, for good reason, right? You got to, people have to be paid a certain amount of money to live on, so those tend to go up. But technology, over time, technology goes down. So GPUs, it's my expectation that the same horsepower of GPU capacity in 2 years will be less expensive, because AMD has a GPU, and their GPU is not as good as NVIDIA's, but it's useful. And if you can create a GPU supercluster with AMD at half the cost of NVIDIA and provide maybe 90% of the performance, money always wins the battle. Money always wins, because the level of investment that you have to make in a large language model, you're taking a big risk. And if you can lessen that capital outlay or that investment, you will. And if NVIDIA can start winning some of these workloads, they can. And that might be exciting. So high level, I think NVIDIA is interesting. But let's see what their fundamentals tell us. So over the last 5 years, not too bad. It's not NVIDIA. It's not like going off the chart here. Over the past year, it's up 40%, but it's had a pretty good, drop. If we look at the last 5 months, okay. It's a $238 billion market cap company, and they do 23 billion in revenue, 10 times revenue. PE 176, very high. Forward PE is 33. Strong buy 32%. Okay. So we talked about cyclicality in semiconductors. Here it is. That's what I talk about. That's cyclical. The cyclical nature of their business is they have good years, they have slow years, and that's what you see in this business. They had very good growth in 2020. Everybody was updating their PCs and so forth. Very good growth in 21. Very good growth. They kind of hit a wall in 23. Let's look at the quarterly. 8% growth in the last quarter. That's very good. So revenue, the reason I use revenue as a very important barometer is this tells me customers are buying AMD products. Customers are finding more ways to use AMD products. AMD is finding its way into that data center. It's finding its way into the marketplace and succeeding. So that's good. I like the growth I'm seeing. Balance sheet. So cash is $5 billion, and how much money do they owe? $2.2 billion. So really they can write a check and say, all right, everybody they owe money to, stop calling me. I just paid you. Leave me alone. But they obviously don't do that. Cash flow. So we've got free cash flow. This was always my hang up with AMD. I kind of rooted for them because 20 years ago, they were like the whipping boy for Intel. AMD kept trying. They just never made market share like advancements that they wanted. So I'd be like, man, these guys, someday they're going to get it right and so forth. But what always prevented me from being all in on AMD is their cash flow. Semiconductor companies produce high free cash flow. I show in NVIDIA, I'm projecting them to be what size cash flow company? 71 billion in the next 12 months. And then we go to AMD and go 1.3 billion. Whoa, what? Like, are we talking about the same industry? And that's always been my hang up with these guys. So AMD, a lot of like strategic things, I'm like, I like it. And then I get the cash flow and I'm like, wah. All right. I cannot get, so if I go 1.3 billion and compare it to their market cap, I have to multiply that number by like 180 to get to this number. There's no way I'm going to get anywhere near this valuation. The only way you get to that valuation is if I don't listen to Charlie Munger and I go all in on earnings per share. Charlie Munger did not touch earnings per share. He said it was BS because GAAP accounting rules do give the leadership of a company the ability to move money and make that number look prettier than it should be. I get that, Charlie. Rest in peace, sir. You were awesome. But you can probably get there if you use the earnings per share and you see their growth. But you know where my head's at. My head is squarely on free cash flow. That's where the money's at. If you look at, and I'm going to open a new tab here so I don't lose my train of thought there. But when we look at the most valuable companies, I could pick any one of these. And let's go with Meta, since I own Meta. And we go to their cash flow. Look at this cash flow. And it's gone up over time. They're at $50 billion of free cash flow, and they keep growing it. And they have these strong moats. And this is why Meta's worth over $1 trillion. Is their cash flow is just incredible. So AMD, if you don't have cash flow, I don't know how you're going to keep that market cap. I love what you're trying to do. I'm rooting for you, but it's just, you're just not NVIDIA. You're not even Intel in its heyday when it was doing decently. It would produce like $15-20 million of free cash flow, and AMD would be at like $1 billion. And I'd be like, why are they so far behind? I think part of it is, I don't know, to answer that question very quickly. Just when I would get here, I'd be like, okay, this is not an investment for me. I have to stick to a lane that works for me. Investing is, I try to simplify it as much as I can. It's already so hard that I need to simplify it and find a recipe that works for me. I'm giving you the recipe that works for me. And I've repeated it and repeated it. Yeah, I buy a stocks from time to time that do poorly and I sell them. But most of the stocks that I buy really work. So I have to stick to that recipe. And that recipe, one of its main ingredients is free cash flow. It's like, I aim to make, a nice dinner, and it's going to have a nice piece of fish, beautiful piece of fish. It's a white fish. And the free cash flow is the main entree. It's that fish portion. The sides, the vegetables, the rice, pilaf, those are nice to haves. But the fish is what costs the money on that plate. Free cash flow, in my recipe for the best dinner that I could have, that's going to make me the most amount of money, free cash flow is it. And AMD doesn't have it. So that's my opinion on AMD. I don't know that's ever going to change, because I've been analyzing that company for 15, 20 years. It's never been different. Crazy. All right. And then Brian's back. Brian usually brings Brian has very good ideas. He wants to look at HRB. That's next on the list. Now we're going to turn our attention to KRUS. Kura Sushi USA. Kura Sushi operates technology-enabled Japanese restaurants. Oh, wow, man. So this is a restaurant company. Man, I'm glad it's not around dinner time. I'd be like getting hungry and hungrier every second I watch this. So it looks like very cool. Where the heck are their locations? I don't know that I've been to one of these. The last awesome Asian meal I had was in New York. There's a Korean market. I don't know if you guys have been to it, in Manhattan. One of our cousins, their son is working at Amazon, and he got moved to New York, and we were hanging out with him, and he took us to this Korean restaurant that was out of this world. Just so good. These guys are Japanese, of course, but makes me think of that experience. All right, so this is a restaurant. Very interesting idea. Let's take a look. I don't like restaurants because you have to hire people. You have to rent expensive real estate. There's just so many things that can go wrong. And restaurants, it's not like, hey, this restaurant was one of the most valuable companies on the stock market. You'll never hear that. You might hear that, hey, Chipotle is worth 70 billion. Hey, great. McDonald's is worth 200 and some odd billion. And McDonald's has been around for 50, 60 years, right? So they've been around for a long time. And they're a dividend machine, which is great. What is McDonald's worth? Let's see. think the symbol is MCD, right? Yeah. So they are worth 200 million, and they've been around forever, right? And okay, I'll say McDonald's is kind of cool, but if you look at their debt level, that might surprise you that they have a lot of debt. And they did create a model where McDonald's is more like a real estate company. They own the real estate, rent it out to the franchisee, and that's how they make a lot of money. But back to Kura Sushi. So it's a $739 million revenue company. So it's a small company. And I'm got it all backwards here. It's not 739 million revenue. It's 739 million in market cap, and revenue is 226. They are losing a lot of money. Oof, man, that's a lot of loss. So what's going on? So they are growing their business. I mean, it's new to me. It might be new to a lot of people. Yeah, they're growing really fast. Okay. Taking a lot of losses. What kind of balance sheet do they have? Let's see, 60 million in cash, debt 135 million. And that's not a lot of debt. Okay, good. 60 million. They have about 65 million in net debt. And I don't know if they have any EBITDA. They probably do. So 8 million. Whew, that's nothing. That's such low EBITDA. It would take them 8 years to pay off their debt, but they're in growth mode. Okay. So let's just keep going along here. I'd be surprised if they had free cash flow. Yeah, that's kind of met my expectation. So this one here, this is not an investment for me. This is in an industry that I don't invest in. I own one restaurant. It's Starbucks. And I think people could argue that, well, that's not a restaurant. They sell coffee. And they're the number one player in the coffee biz. And I like players that have separated themselves clearly from the competition. And I feel Starbucks is in that situation where they have beat out everybody for premium coffee. And they do serve food in the restaurants, but it's kind of like pre-made somewhere and then warmed up at the location. So it makes the serving of food quick and I think profitable. And the coffee is very profitable. So that's the one restaurant I own. That's the exception. I'm glad I own Starbucks. An investment like this is just too high risk. We look at I'm surprised their stock price is where it's at, and they are traded on the NASDAQ. I mean, there's probably a story behind this that some really famous person, has this idea. For all I know, this person is like really good at opening restaurants, has a lot of credibility in the space, maybe, but it's just not the right investment for me. I'm looking for the next Meta, and I would, if these guys are incredibly successful, they'll get to a certain market cap. I mean, you still make a lot of money if you invested at this level, but I just see so much risk. There's so many things that can go wrong. They're not making any money. They're burning cash. I mean, the list of concerns is really high for me. So I'd have to be a pass on KRUS. What's your curious Acer 8? What are you trying to do with this stock? Are you just trying to trade it and make some quick money? Yeah, they're opening a lot of stores. Yeah, I agree. There's a, what do you call it? There's a noodle house that opened near my home, and I'm near Irvine, by the way. And this restaurant opened, and it's a Japanese noodle house, and the inside was just beautiful. And this place was awesome. It was a little pricey, but I thought it was worth the experience. Not every week, maybe every other month. Go there, check it out, have some of their noodles, delicious. And they didn't make it. And I just think to myself, man, so you had to pour all that money to make that restaurant look super cool. You had to hire staff, train your staff, get everything operational. You get it up to speed, and you don't make money, and you go bankrupt. And that location's now, it's been converted to a different restaurant. And that's what they're faced with. And it's got to be so damn tough. Starbucks, I think, is a little different because it's coffee. It's like, man, it's a simple recipe. You get premium beans. You have a central facility that roasts the beans. They come to the location. They get ground. You pour hot water into those grounds. Out the bottom comes out a dark liquid. You serve it to a customer. Give me $4. All right, sounds good to me, man. They make money. I'm happy, and away we go. Yeah, let's talk about something real quick, and then I'm gonna get to HRB. So there's a lot of businesses that we can put our heads around that are quite easy to put our heads around, and especially ones that market a lot, but they don't have a lot of value. And there's really popular businesses that you would think, oh man, they must be making a lot of money. The car business being one of them, right? Automobile. You look at Ford's valuation, it's like so damn low. Everybody knows Ford. Everybody understands what Ford does, but they're just not a very valuable business. So there's some businesses that are incredibly valuable that people don't really know about. I don't think the average person knows NVIDIA, as an example. So I get that they can be quite popular, but investing is about, show me the money, show me the cash flow, show me the fundamentals. There's a lot of businesses that are worth a lot of money that people just don't, the average person doesn't know about, doesn't understand. All right, so HRB. H&R Block. This is a services company. Okay. Now, these guys are both services, and they would like to compete against TurboTax, which is owned by Intuit. And I'm familiar with this marketplace. I was educated in accounting. Part of my accounting curriculum was tax. I really enjoyed tax. I've done my taxes ever since. I used to do taxes for my family and some close friends, but it became too much of a burden. And I said, no, I'm just going to do my own taxes. And I do the taxes for my two sons. And that's the extent of it. And these guys, let's look at their growth. They've been growing. That looks pretty good. They did have a down year here, but they bounced back. Okay. And H&R Block was like purely services a long time ago, but now they're getting into the software biz. Their market cap's really low. 8.9, revenues 3.6. They do pay a dividend, and their PE is very manageable, 15. So we saw that their growth was okay. Balance sheet, $1 billion in cash, and how much debt? Total debt, $2 billion. Not bad. $1 billion in debt, net debt. I'm going to guess that their EBITDA is going to be reasonable. Yeah, they can pay debt off in 1 year. Okay, good. Cash flow. Free cash, it's been steady and at around $657 million. They had a good year in 23, down year in 24. But I'm going to call it, they do about $700 million of free cash flow. They're fairly priced because it's not an exciting business. It's not a growing business. If you multiply 7 times 10, you get to 7 billion. You could probably substantiate the 9 billion. The thing about these, you could have picked these guys up for a really good discount way back when. It made some good money. Look at that. The 1 year, 60%. So it looks like we're late to the party on H&R Block. The money's been made. There's some forces that, would be liabilities for H&R Block. One is TurboTax, the number one player. They're not going to leave that spot unless you, I don't know what you'd have to do. But TurboTax is the number one player. Intuit is far more valuable. So Intuit's a $176 billion company. And Intuit does a couple of things. They do TurboTax. They do QuickBooks, which is kind of an accounting software. And they do a couple of other products, but that's mainly, TurboTax is one of their franchises that's been incredibly successful. So it's a very big difference between, Intuit, which is pure software, and now they're beginning to do some services. If you're a TurboTax customer, you know what I'm talking about. These guys were pure services and now are trying to compete with software. Their valuation's not even close to Intuit. But yeah, I think the money's been made on H&R Block. It's a sound business. I can't say many bad things about it. It's just not something that I feel like I'm going to wake up 5 years from now and it's going to be worth $120 a share. I actually think the opposite. I think you could wake up 5 years from now and it's worth $60 a share. And that wouldn't be good. So if they were the number one player like Intuit and I was getting a fair price or a discount, I'd be all ears and trying to track it and wait for it to drop and then buy into the number one player. Like Intuit, I'd be game on buying into it, but it's usually priced at a pretty good premium. Every time I look at Intuit, it's just priced too much at a premium. And there's other software categories that I'm invested in. So I'm good when it comes to software. I own 3-4 different software companies. So it's not like I'm starved for a software business. So that's my opinion on H&R Block. See, tax season. No, we're not in tax season. We got 4 months before the year's over, and then tax season will really be about 5-6 months from now. Time to pay Uncle Sam at that point. All right, I got through the symbols. That's good. I think it's a good point to kind of start landing the plane. Let's take a look at the stock market. We are not in future territory anymore. Wow, the NASDAQ. Go NASDAQ. The Russell is lagging. S&P, Dow. Okay, it's a green day. Not the rock band. It's a day where positive stock prices. All right. What's going on with our boys over at NVIDIA? They're still down. Up market, these guys are still down. I wonder what's going to happen. Are people going to pony up some cash and buy some more shares? Is this, I said this, before they announced that NVIDIA is one of those things that, yes, it's going to be super interesting what happened last night, what's going to happen today, but really the next chapter is going to be somewhat written over the next 2 to 3 weeks. If over the next 2 to 3 weeks, there's a sell-off, it's going to be painful to NVIDIA stockholders. If it rallies, it's going to be amazing. It's going to be like, wow, where are we going to go from here? 3 trillion, 4 trillion, 5 trillion? Because you're not attached to a valuation anymore. You can go as high as you want, as high as people are willing to pay. So we'll see. All right. Yeah, I get that if money comes out of NVIDIA and other stocks that have been overheated, that money, there's other places that look pretty damn good. To me, healthcare looks really good. Other parts of technology like software look really good. I'll show you Adobe. So Adobe is a long established company, a pretty good market cap. You're paying about 12 times revenue. And you look at this company growth. You look at their cash flow, really nice cash flow. Okay. And right now I have Adobe at like a 10% discount, but they are the number one leader in creative software. Artists, Adobe Acrobat, they have certain products that are just franchises, kind of like Intuit. Having said that, when we talk about money rotating out of NVIDIA, there's other homes that money can go towards. Adobe being one of those homes, as an example. Or it could go into a healthcare stock. If that investor wants big cap, there's really good choices of pharmaceutical companies that are high free cash flow. They have good appreciation potential for the next 12 to 24 months. Smaller caps have great potential. I really like United Therapeutics. And as always, guys, I'm citing my experience, my opinions. I don't recommend you buy, hold, or sell any stock I ever cover. I don't recommend you short any stock either. But United Therapeutics is a fantastic company. They've been up recently. They're up again. These guys are a smaller cap, company. If they keep growing and adding value to their market cap, they're not going to be small cap forever. But they have awesome fundamentals. They have awesome ideas. You study them and you're like, I'm just so impressed with what they've done to this point. And they're very ambitious. They have an ambitious growth plan. Scientifically, it would be, they already did something scientifically that's super impressive. But if they're successful in the next business they're trying to create, which is growing organs in a laboratory, which are transplantable to a human being, I just think, okay, you just opened up a new marketplace of people that need an organ, especially late in life. And what would they pay for that? 50 grand, 100 grand? Yeah. So, and insurance would cover it probably at some point because, there'd have to be some coverage where, hey, this person's dying. And if they got an organ, they're going to live. Okay. There'd probably be coverage for that. So it's really a fantastic, potential. Like if they pull that off, I just think the company is going to be worth 100 billion. But again, if they pull that off, if they don't pull it off, they still have businesses that are franchises that are really, really valuable. And that's what I'm basing my fundamentals on. If the other business works, that's icing on the cake. So that's where money, I think, could rotate out of NVIDIA. There's lots of places, thousands of companies. Since we have choices of thousands of companies, let's pick companies that are in industries that inherently produce the most valuable companies on the stock market. The most valuable companies on the stock market. Let's take a look at the mega caps again. Technology. Oh, here we go. Berkshire Hathaway. Okay. Pharmaceutical. Financial services. Big diversified retailer. Pharmaceutical. Healthcare. Energy. Financial services. So the recipe for success is kind of hidden in plain sight, right? You look at these companies, healthcare, financial services. I call this technology because they're the advanced streamer. Pharmaceutical. You've heard the word pharmaceutical 5 times, right? In the top 30, you have a lot of pharmaceutical companies. And these companies have been left behind by technology. I believe that healthcare is going to rise and really do well in the next year to 2 years because they've been left behind and their fundamentals look great. You look at, the valuation of Pfizer, United Therapeutics, Catalyst Pharma, AbbVie. I was an AbbVie stockholder for a long time, but they're beginning to concern me on a couple areas, but they look good. They look really good. So as they rotate, if you rotate and investors rotate out of NVIDIA, there's plenty of places to put your capital to good use. All right, everybody. Looks like I answered all the questions. I've got 38 viewers. Thank you so much. Good luck today. Good luck in making some money. It looks like the stock market is clearly in the green. We are clearly in the green on all indexes. The economic news was positive, so there shouldn't be any like cloud over this this stock market today. And we'll see if the market's going to run. I think it has the potential of running. And I'm going to do this again tomorrow. It's at the same time, 9 a.m. Eastern, 6 a.m. Pacific. We'll see where the market ends up today, and we'll see what is going on tomorrow. And I'll be doing this each morning at 6 a.m. I think this works for me. This is pretty much kind of like in what I do. I usually don't trade in the first hour, for sure the first half hour when the market opens. So I can kind of get my head in the game and kind of get my juices flowing, drink a little coffee with you guys. And then if the market is giving me good prices, maybe buy some stocks, buy some shares, maybe sell a few options, maybe buy a few options, maybe short a stock from time to time, maybe buy some bonds. So it'd be nice to start my day with you guys. If you guys want to tune in again tomorrow, same time on Stonks. And for now, everybody, best of luck investing. Thank you so much for tuning in. Take care.